want to take a look now at what I've called the Berkshire Hathaway system. This is an ecosystem created by Warren Buffett over the last 50 to 60 years, which has been particularly effective at making good acquisitions. So I'm going to take a detailed look at how Warren Buffett has avoided most of the problems and issues we've identified in this course. As a start, I've summarized the way that Berkshire Hathaway operates in a PDF which you can download with this lecture. It's called the Berkshire Hathaway system. But allow me to focus your attention on some of the most important parts of this summary, particularly in regard to how this impacts the way the company makes its acquisitions and manages its subsidiaries. Berkshire Hathaway is, in essence, a diverse conglomerate. It doesn't actually have any sort of strategic plan. It doesn't produce monthly accounts or anything like that. It's run on a very unconventional way. He also, has to be said, pays little or no attention to Wall Street. Warren Buffett and Charlie Munger only invest in businesses that they can understand. So in the dot-com boom, they were conspicuously not getting involved in any of the internet stocks because they argue they just didn't understand them. And with hindsight, although they received a lot of criticism at the time, with hindsight, it was very smart. While control at Berkshire Hathaway is centralized, the running of all the separately incorporated subsidiaries is highly decentralized, with a great deal of autonomy given to the CEOs. Head office only comprises a tiny office with all the key investment decisions being made by Buffett and Munger, with no regard to external advisors. The cost of their central operation is minute. It's something like 0.01% of the net assets or the net worth of the company. I think it's last time in the last letter for 2000, it was about 23 or 24 people. And it's grown very, very slowly over the years. Charlie Munger lives in California and doesn't actually even come to the head office, the Quotes head office at Kiewit Plaza in Omaha. And he and Buffett just do all their work together over the telephone. While the company operates incentive schemes within its subsidiaries, which are focused on those businesses, and these incentive schemes are very highly tailored to making sure the right incentives are in place to get the results they want, because we've discussed the importance of incentives. There is no company-wide bonus or share option scheme. But Buffett and Munger themselves have no share options, nor any other incentive scheme. But significantly, they do have the vast majority of their personal wealth invested in the shares on exactly the same basis as other shareholders in Berkshire Hathaway. Buffett and Munger choose all the subsidiary CEOs. Now, these often come with the businesses they acquire and are nearly always the existing business's CEO and often the previous owner. In the entire history of Berkshire Hathaway, and I don't know of another company I can say this of, no CEO of a subsidiary has ever left to work elsewhere. Buffett and Munger's primary focus is on capital allocation. Now, existing subsidiaries can reinvest with a very high degree of autonomy, with the goal of increasing their competitive advantage in the long term and obviously shareholder value. There's no focus on EPS or on growth or on targets. They're just left to get on with it. Any surplus capital is redeployed by Buffett and Munger from the centre, either to acquire additional businesses or to make securities investments. And again, they do this as and when they feel they find an opportunity. And if they don't find an opportunity, they don't do anything. So they're not out there rushing all the time trying to make deals. And sometimes you hear Buffett talking in his letters about the fact that he hasn't found any opportunities, so he hasn't made any acquisitions. Buffett and Munger see themselves as partners with their shareholders, and they treat all their shareholders exactly as they would wish to be treated. The culture in the whole organisation is designed to work well for customers, shareholders and employees, and that's borne out by the results. Acquisitions are made with cash whenever possible. Buffett hates issuing new stock because he recognises the dilutive effect this has on all shareholders. Now, we're going to look at some of the mistakes he's made, but in one transaction, I think it was Dexter Shoes, he actually paid for part or all of that company in Berkshire Hathaway stock. The net result of that acquisition was one of his failures, and we'll explore his failures in another part of this section. But he reckons that $300 million deal ended up, because he issued stock, ended up costing him $6 billion. And that's one of the prime reasons he doesn't issue stock. Berkshire as well does not pay dividends. Instead, it's continually seeking to redeploy capital to create shareholder value. When making acquisitions, Berkshire seeks to pay a fair price for a good business. It does not participate in auctions or IPOs. And it's important that acquired companies come with CEOs who have skill, energy, and integrity. I'm going to talk to you about the acquisition criteria that Buffett repeatedly sets out. And I'll explain to you why he sets the criteria out in the way that he does. Berkshire almost never moves a CEO between subsidiaries. There are one or two exceptions to this in Berkshire's history. Berkshire never makes a CEO retire on account of age. Buffett and Munger are 90 and 97 years old respectively, and still doing a great job. Berkshire uses no debt for acquisitions, and apart from certain businesses where debt is appropriate, mostly non-recourse to Berkshire Hathaway, as Buffett does not believe in the use of leverage. In their railway operations, for instance, there's a lot of capital expenditure going in. These are regulated businesses, and part of that capital expenditure is financed with a sensible level of debt. But that debt is only guaranteed by the subsidiary, I think it's BNSF, and not by Berkshire Hathaway. So it's used in a sensible way for the business, but for most businesses, it's never brought into the equation. Significantly, Buffett makes it clear that he and Munger are always user-friendly to prospective sellers of large businesses, promising, and it has to be said, delivering, absolute discretion. Information is only shared between Buffett and Munger and no one else. No advisors or investment bankers are ever involved. We're going to look more deeply at how Berkshire operates to see how this helps to create an admirable acquisition record. Importantly, though, it is not without its mistakes. Both Munger and Buffett, mostly Buffett to be fair to Munger, has made some poor investment decisions with hindsight. But very often it's because they bought businesses, not that they didn't understand, but where the industry they were buying into had adverse long-term outlooks, which they didn't entirely appreciate. But we are going to take a look and see where Buffett has gone wrong in order to deliver a balanced approach and a balanced evaluation of how this all works. So that's an introduction to the Berkshire Hathaway system. As you can appreciate, I'm a huge admirer of the way Berkshire has operated over the years. I only wish I had bought shares when I might have been able to 20 or 30 or 40 years ago. I didn't. But I nonetheless think there's an awful lot one can learn from studying the way that business has been run and operated. And I strongly and highly recommend that you consider doing that.